Good morning, good morning, good morning, good morning. Let's see here as we get started. I am happy to be up this morning and getting ready to do another live in regards to financial literacy. So I'm pretty pumped about it and ready to get this day started and ready to get this live started. And today we will be talking about not only financial literacy, but we'll be talking about does a good credit score. I think that's a good subject to talk about. Does a good credit score matter? Let's see, I'll give everybody a few seconds to jump on in and we will get this party started. Let's see here. So, good morning to everyone. And like I stated earlier, going live today on Facebook and on YouTube. Let's see here. And as we're going live on Facebook and on YouTube to discuss does a good credit score really matter? It's a great topic. It's something that usually affects a majority of people, most people. There are a few people that it doesn't affect at all, but for the most part, most people, uh, credit scores, credit reports, credit profiles, having a good credit score doesn't matter. Most people, it does affect them. Now, of course, the past two Saturdays, we've talked about different things. So this is completely different from what we've spoken about the past two Saturdays. And if you missed the past two Saturdays, we talked about budgeting. We've spoken about other financial literacy subjects, but we talked about high yield interest savings accounts and why it's important to put your funds in a high yield interest savings account. And we also talked about retirement accounts as well. We talked about Roth IRAs, we talked about traditional IRAs, and the difference between the two. And so we're always going to talk about making your money work for you. And we're always going to talk about passive income and the importance of it as well. And so as we deal with today, talking about does a good credit score matter or not? Think about how your credit score has affected you. Think about the different opportunities or different things that have come before you over the past few years, over your lifetime, and how much of it was connected to your credit score when you tried to make certain financial transactions or moves. Now, keep in mind anything that we discussed today, always do your own research, always go back and fact check, always go back and double check to make sure that information is accurate and good and up to date. Do not just solely rely on me as your only source of information when it comes to financial literacy. So, today, when we talk about a good credit score, one thing we have to understand is the national average. And this is an interesting stat when we talk about the national average. You know, they say that the national average is somewhere for a credit score is somewhere around 700 to 715, somewhere in there, a little over 700 basically is the national average for the average credit score. Now, here's what's interesting about that. Even though the national average for credit scores are about 700 plus, it doesn't really give you a full scope and picture about the average for different groups, for different classes, for different cultures, different races. So that would be a completely different average than the national average. So keep that in mind and give yourself something to think about and look up what is the average for your culture, your race, your group of people as well. because it'll put other things into perspective and it'll help you understand what's going on and why it's going on. So when we look at does your credit score matter, the national average is about a little over 700. And so to make sure that we don't confuse anyone, you have a credit score and you also have a credit report, which would reflect your credit profile. And so we're not necessarily talking about, well, we are talking about your report and your score today, but just know that your credit report is going to be detailed information. Your credit score is just going to be those 3 digits. And so when we talk about what your credit score is, it's those 3 digits, whether you have a 500, whether you have a 600, a 850, a 700, those 3 digits are your credit score. Not, and so understand, like, a credit report is almost like a test. Your credit report is the test that you took. It shows the history of your actions and what you chose to be your answers. Your credit score is almost like your grade for your test. Credit report is the test you took. Your credit score is your grade you made from that test. So try to keep it, use that as an example when it comes to understanding the difference between your credit score and your credit report. Now, when you look at your credit score and how it came to be, you must understand that there's different factors that go into play when a credit bureau is deciding what your score is. Well, they don't decide what your score will be, but your actions, your history help dictate what that score is. But how they come to that conclusion, how that method is concluded, is based off of about 5 things. 1, your payment history. 2, the amount owed. 3, the length of your credit history, the type of credit, and also whether or not you have new credit. So those are the things that they're going to look at to dictate, that will help dictate what your score is. The payment history, the amount owed, the length of credit history, the types of credit you have, the diversity you have in the types of credit, and new credit, most recent credit. All of that will play a role in your what you'll see on your report and also in your credit score. So as we continue, just know that each one of those 5 things have a different percentage that is contributed to your score. 35% is payment history, how often you make a payment, how consistent you make those payments when you talk about your score. Also, keep in mind, when we talk about your credit score, you can have your business credit and you can have personal credit. And right now, I'm just speaking on your personal credit. And so when we deal with personal credit, 35% is payment history, 30% is amount owed. So right there, you have 65% of your score that is factored in right there. 15% is length of credit history. So when you look at the length of your credit history, it's talking about how long have you had that credit? How long have you had that line of credit? How long have you had that credit card? How long have you been using it? And like I mentioned earlier, 35% is payment history. So are you consistently making that payment every month? And to be consistent, all you have to do is make the minimum monthly payment every month on time. And that's key. Don't just make it, but make it on time. The amount owed, how much do you owe on that credit? So, for example, if you have a $500 credit card limit, but you owe $495, well, the amount owed is over 50%. You're almost at 100% as far as usage rate. So that's something that you have to look at as well. You don't want your usage rate on those lines to be high. I try to, if I use a credit card, my goal is to always stay around 30% usage rate. So the length of credit history is 15%. The types of credit that you have, the diverse, the amount that you have, whether it's a mortgage, house note, whether it's a car note, personal loan, credit cards, those are different types of credit. So that counts as 10%. And of course, new credit counts as 10% as well. And that's how they get the full 100% to calculate and give you your grade. And so when we look at your FICO score, FICO means Fair Isaac Corporation. Of course, we always hear the word FICO, but we never really know what it actually, but the FICO means, but it's Fair Isaac Corporation. So basically, that's the method that they use to help predict your score and basically help them predict if we loan this to you, what is the likelihood that we will get our money back? What is the likelihood that you will actually pay us back and pay us back on time? So keep that in mind when we talk about this. And the reason why these credit card companies or these other financial institutions use this FICO method is because they want to mitigate their risk. They want to make sure that they either get their money back or they do a great job of getting so much from you up front that if they don't get as much back, they have mitigated their loss that they may take. But that's a different subject that we'll get to. But is your credit score important? Is it important to have a good credit score during this time? As you continue to live your life and you go about to do certain financial transactions, do you need a positive credit score? So when you look at is it important or not, it also dictates on what you plan on doing. What are you trying to do with your score? What are your plans of actions? Are you trying to buy a house? Are you trying to buy a car? Are you trying to go into business? And when we look at your credit score, you must understand that your score is completely based off your history. It's based off of your financial history, which helps dictate opportunities. Now, the unfortunate part when it comes to credit scores is that some people, when you look at their credit report, some of that history they had nothing to do with. Some of the history they did not create, but something was put on your credit that you didn't put there. And I'm not sure if anybody who's listening, but it has happened to people that they had a credit report or a credit score and something was put on their credit, but it wasn't their fault. They didn't do it. And so you must keep in mind that some people have credit scores and credit reports that aren't favorable, but it's not their fault. And so as we look at does your credit score matter today, if something is on your score, on your report, and it shouldn't be there, it's definitely important that you take some action and try to get those things fixed immediately. Because what I found is when it comes to this whole theory and this whole idea of having a good credit score, when it comes to your report and your score, it is easy for them to add things on there, whether they're good or bad. But it is somehow difficult to takes longer to take things off than they put on. They will quickly put something on your score, on your report, whether you did it or not. But when it is time to take it off, get it removed, or get it fixed, the process takes a while. And so if you do have a problem like that, I would definitely reach out to a professional, someone who can help you get that fixed, someone who has a good company or a good track record of guiding people through that process to get their credit fixed as well. So as we continue to go on and talk about this, just know that your history is going to dictate what your score is. So if you had late payments in the past, then that's going to affect your score. And so if you apply for a lot of credit over and over and over, then of course that's going to cause a hit on your score as well. If you stop credit activity and you just quit using lines of credit, if you quit and let's say, here's the interesting part. Let's say you're debt free, you don't owe anybody, you don't have a car note, you don't have a house note, you don't have credit cards, you don't have personal loans, you don't have student loans. If that is the case and you don't have any credit activity for a long period of time, it could affect your credit score as well. And so you may end up having a lower credit score or no credit score if you don't have any credit activity for a long period of time. And just remember, if I haven't touched on it strong enough, that your utilization rate matters. How much you use, example, your credit card. If your credit card balance is $500, you should want to stay around 30% usage rate. And you do not want to max out that card. If you max out that card and the charge date passes, then your utilization rate is going to show that it is at 100% if you use $500 on that card. Now, what's interesting is technically you can max out that card and then pay it off the next day, and it may not affect your utilization rate as if you were to keep that balance on the card over that month period of time. So another benefit of paying that card off before that charge date is the fact that you won't pay any interest on that card. And so if you do have to use a credit card and you can pay it off before the charge date, then you can save yourself a lot of money in interest every month. So when we talk about does a credit score matter, there are 3 credit bureaus. Anybody know the 3 credit bureaus? I'll pause and see if anyone can type it in. Of course, I am on YouTube this morning, YouTube Live and Facebook Live. And so feel free to jump in on either platform, whether it's on YouTube, whether it's Coach Steele Finance Training on YouTube, or whether it is on my Facebook, which is Simon Steele. So does anyone know the 3 credit bureaus? Does anyone know the 3 credit bureaus? These beautiful credit bureaus that show you or report your score. I would say that they report your credit score. Does anyone know the name of those 3 credit bureaus? Well, let's see. I will name one of them. One of them is TransUnion. One of the credit bureaus is TransUnion. The other one is Equifax. And lastly, the other one is Experian. So when you look at your credit score, does your credit score matter? You're going to probably see a few different scores, and it depends on where you look to find your score on what that score may be. And that's the confusing part for some people is they go to look up what their score is, and depending on where they go look, the score may say one thing or another. Credit Karma may say one thing, but your Experian score may say one thing, but TransUnion says another. That those 3 credit bureaus, TransUnion, Equifax, and Experian, are those 3 credit bureaus. And so it is good to know what your credit score is. Now, there are mortgage scores. Then if you go to get an auto loan for a car, then they may look at your auto score. So every place may look at a different agency to decide what score they're going to use. So certain financial institutions aren't going to look at, and I'll explain it better. Certain financial institutions aren't going to look at all 3 bureaus. There are certain banks or financial institutions that they may only look at one of those bureaus. So a financial institution, when you go to get a mortgage, you may say, oh, my TransUnion score is 690. My Experian is a 692, but my Equifax is a 710. Well, guess what? There may be a financial institution and they only look at that higher score, that bureau, whether it's Equifax. And so they may only see the 710. They'll never see the 690s. So some people are worried about their score when the financial institution that they're going to doesn't even look at those other bureaus. They will only see that higher score. Same thing. There may be other financial institutions that decide to look at all 3. So whenever you're getting ready to apply for credit, before you do, ask that institution what bureau do they look at, so you'll know and you'll be prepared and you'll know exactly what they're looking at. So it'll also dictate where you go to apply for credit, where you go to apply for a mortgage, where you go to apply for a credit card, you name it, the list goes on. Do your research. And so, does a credit score matter? It's a great question that we have this morning, and it's so much to cover as we go through and cut it up and get through these bits and pieces of this meal. But does a credit score matter? One thing to think about in this whole process is, if it does matter to you, what financial institutions are you using? So make sure that you use an institution that is favorable to you and your score, depending on what bureau they use or bureaus. So some people have great credit scores. Some people have 800 plus, but um, they may hardly ever use any credit, in the sense of they may just go here and there using credit for whatever. It's not a constant thing that they need. So, and some people have great scores. And what's interesting enough is they may not use any credit at all. How is that? Someone may add their name to their credit. Uh, and so someone may add their name on something. And of course, so now that's a good reflection on that person. They didn't do anything. They're just, their name was added to certain things. Their name was added to the mortgage loan. Their name was added to a car note. Their name was added to a credit card. So what's interesting about this is there are some people that have great credit scores, but it doesn't mean that they know how to manage money properly. So just because you have a great credit score doesn't mean that you have good money habits. It doesn't mean that you manage money well. It doesn't mean that you've done such a fantastic job with financial literacy, uh, and that you should be teaching other people. It just means that you may have had your name added to the right things, which was beneficial to you. So some people with great credit score, and the reason why I say the question is, does a good score matter? Some people it does matter, and for some people it doesn't, because their name was just added. So therefore, they are the recipients of good scores. Now, there's some people who have bad scores or horrible scores, but it doesn't mean that they were bad stewards. It doesn't mean that they manage the money bad. It just may mean that they don't have any credit history. So you can have a bad credit score or a no credit score because you don't have any credit history. In other words, you didn't borrow any money from anyone. You didn't have to pay anyone back. And because of that, you can have a bad credit score and a bad credit profile. Now, Dave Ramsey is infamous for talking about the fact that he has a zero credit score because he doesn't use credit. He doesn't have any credit cards. He doesn't have any personal loans or debt, and he doesn't use it. So therefore, his credit score is at a zero. So he couldn't qualify for anything, but he doesn't care because he pays for everything in cash. So when we talk about, does a credit score matter for Dave Ramsey? No, a credit score to him doesn't matter. For the average person, it may matter for the average person. So there's going to be a range of people who would say it does matter, and a range of people, a smaller range of people who say it doesn't matter. But a great score doesn't mean you manage money well, and a low score doesn't mean that you mismanage your funds. Now, there are some people who do have bad scores because someone else added their name to something and didn't manage that debt well. And then there's some people who have bad scores because they did not pay on time. They did not manage their credit well, their debt well, and it got out of hand. And debt and credit can get out of hand for a number of reasons. People have emergencies, people lose jobs, things happen, things come up. And as a result of that, financial institutions do not care. They need their money. They want their money. They loaned it out to make a profit. They did not loan it out to make a loss. And so they still have bills to pay, they still have workers to pay. And so financial institutions are still going to want their money. Does a credit score matter? Pros and cons of having a good score and the cons of not having a good score. Well, what I find is for the average American who needs credit to buy a house, to get a car, to get a loan, you name it, the average person having a good credit score does matter to them because having a good score dictates what your interest rates will be. Having a good score can dictate what your interest rates will be. Let's say you get ready to buy a house and you are in the middle of trying to apply and qualify for a loan to purchase a house. Well, getting that credit score at 7% and getting that getting that interest at 7% and getting the interest at 8% matter. So the difference between that point is the difference in how much interest you'll pay when we talk about a mortgage. Keep in mind a mortgage can be a 30-year loan. It can be a 15-year loan. It can be potentially a 10-year loan. But the average person has a 30-year mortgage. So keep that in mind as we talk about this. So if you get if your credit score allows you to get a 7% interest rate, or if it allows you to get 8%, we're talking about the difference between thousands of dollars over a period of 30 years. If your score allows you to get a 7% rate, or someone else has allowed them to get 9%, the interest rate, we're talking about thousands of dollars. So in that case, for the average person who has a credit score and needs that to, or feels they need that to purchase a house, then that makes a difference in thousands of dollars that will be paid over a period of 30 years on an amortized loan. Now, there's multiple ways to buy houses. There's multiple ways to buy property. There's multiple ways to buy real estate. So when we talk about does your credit score matter, for the average person buying a home, their credit score matters. But there are other ways to buy homes. You can buy a house in cash. Now, some people will say, how in the world can I buy a house in cash? Well, there are people out there who are either desperate or looking to make money or ready to get rid of an investment property, or maybe they inherited a property and they are willing to sell it. And therefore, they will give you a great deal. And so you have opportunities to make great deals out there and buy a house in cash. And so does everyone have thousands of dollars sitting off to the side to buy a house in cash? No, everyone doesn't. Or they may think they don't, but there are so many ways, creative ways to buy a house in cash. And I'll give an example in a minute. But so you're not limited to your credit score when it comes to buying a house. So you could technically use someone else's credit, add them on the loan, or also you can buy a house in cash and make a deal. Or also, and there's more houses you can buy in cash out there than people realize. But if you get a good real estate agent and you're doing your necessary homework, you can find some properties out there that you can buy in cash. Like I said, everyone may not have it, but if you do, hey. And I'm not telling you to get a borrow against from your 401k or pull funds out of your Roth. I'm not telling you to do any of that. But if there is a good deal out there and you can replace funds, then hey, that's a profit in your pocket. Plus, you have a property. And then keep in mind, there are auctions out there. There are tax liens as well, tax lien auctions that happen every month, where the courthouse is often auctioning off properties for people who did not pay their property taxes. And so it's possible to also buy a house at a tax lien auction for a very, very low price in cash as well. So you don't necessarily have to have a good credit score to have a place to live or to buy a house. But what I found is, even if you're going to renting, they check credit scores. So a good score does matter for a lot of people because even to rent, your credit score will come into play. Now, for example, years ago, might have been 2019, 2018, I found a property that was for sale. They were selling it, and I tell this story pretty often sometimes when I'm talking to people about real estate, when I'm talking to people about opportunities out there or deals that are out there. Someone was selling a house, 2 bedroom, 1.5 bath for $50,000. The value of it was $50,000. And so I went and looked at the house, of course, examined it. Eventually I had someone come through and, see, what, if there's any more work that needed to be done or not. Long story short, I negotiated and was able to buy the 2 bedroom, 1.5 bathroom for about $30,000. Does everyone have $30,000 cash? They may not. But my point is, it is possible to buy a property or a house in cash. Now, it was a great investment for me because now when we look at the value of that house that I bought, even though I bought it for $30,000 and I ended up putting, I would say, about $34,000, I'll round it up, $35,000 into it to fix it up, to get some things done. Now the value of that property is worth well over $100,000. It may be anywhere between 110, 120. And so now it's worth about 100,000 plus, and I only put about 35,000 into it. So we have at least $65,000 worth of equity in that property now at this point. And so with having that $65,000 worth of equity, now if I wanted to, here's the part, I could either sell it and take the profits. And now I did all of that without a score, because to buy that property for $30,000, all I had to do was come to the table with the $30,000. Did not need a personal credit score to do this deal. So in that case, a credit score didn't matter. In certain people's cases, a credit score doesn't matter. And at the same time, even without a personal score, someone could easily go get a business loan without using their personal credit score, and do that same deal. So you'll find in life that sometimes a credit score doesn't matter at all. It's about negotiating and finding opportunities that fit your profile and what you're looking for. So in that case in life, credit score doesn't matter. Give them the 30,000, I get the property. And so now what's interesting is, here's a twist. With having at least $65,000 in equity in that one property, now if I wanted to, I could get access to that equity in that property and then take that 65,000, put it in my pocket and spend it away and go have fun. Or I can take that 65,000 worth of equity and reinvest it into another property. And when I reinvest it into another property, then that property would bring in cash flow just like this rental property. So, which I didn't mention, the property I bought for about 30,000, I rented it out. And because I rented out, it is cash flowing, which paid me back the $35,000 that I put in. And so it's possible to buy a house. It's possible to buy a house for yourself or an investment property without using your credit score. So never allow not having good credit to stop you from doing business, making transactions, and growing a real estate portfolio and passive income. So in that case, a credit score doesn't matter. I was hearing the other day, someone said that even to get a cell phone companies are running people's credit as well, which means they're probably trying to sell you something. And so let's look at some other things when we talk about pros and cons of having a good score. And when we look at when we look at some of the negatives of not having a good score, it could potentially affect how much you pay on insurance. Your insurance could potentially be higher if you have a lower credit score. So keep that in mind that for the average person who needs to use a credit score, you would end up paying higher interest if you bought a house. And if you pay higher interest if you bought a house, if you had a house finance, then it's going to cost you thousands of dollars in the long run. So it's better to have a better score, a better credit score, as opposed to a worse one when you get ready to buy a house. It makes a difference on that interest rate that you get on that 30-year amortized loan. Same thing if your credit score affects your insurance, then at the same time you're paying higher insurance. So if you have a lower credit score, think about this. If you are buying a house and you're getting insurance on your car and you're buying a car, somebody with a lower credit score is going to pay for a higher cost of living than someone who has a higher credit score because they're going to get lower rates and better deals. So, someone who may not ever borrow any money from anyone, who may not have a good credit history because they pay for everything in cash, will pay more money monthly for things because they stewarded their money properly. So it is possible to have to pay more for things because you managed your money so well that you didn't have to borrow any money. It doesn't make sense. And so when you look at the issues and the concerns of does a good credit score matter, what's interesting is people who never have to borrow any money may end up having to pay more for things because they never had to borrow money. It's pretty interesting. And so you have to figure out and decide for your lifestyle, is it worth it? Is it important? Should you lock in and improve your credit score to improve the fact that you will not have to pay as much for things? So what's interesting and what we come to find is having a good credit score helps you with your budget. Having a good credit score will save you money in the long run if you have to buy certain things. If a insurance company is going to charge you more for having a lower score, then it is beneficial to have a higher score so that your expenses are decreased. Now, what does that mean? That means that they're almost twisting your arm and telling you you need to go borrow money from a financial institution. You need to go leverage yourself and borrow money from a financial institution so that you can show that you have a good score. And because you show you have a good score, now we will give you better rates. Now, what you have to be careful is when you go to improve your score, when you're trying to get a good credit score, don't do it at the detriment of your cash flow. I think that's important to talk about right here. When you go to improve your credit score, do not do it at the detriment of your cash flow. What does that mean? Getting a good score, but don't do it at the detriment of your cash flow. I'll tell you what that means. Just because you need to improve your credit doesn't mean you should go race out there to put yourself in a bad deal or to go use a credit card profusely, excessively without a plan. And now you owe a financial institution, credit card company. Now you're paying interest on this card every month just to improve your credit score. No, you need to be very strategic about how you improve your credit score. You need to be very strategic about what you do to improve your credit score, to raise that score, because, like we mentioned before, There are times for some people, credit score doesn't matter. You can still have success, just like the example I mentioned earlier about how I purchased a house using cash. Score didn't matter. But once you start uh, trying to improve your score, don't do it at the detriment of your cash flow, because then you're working backwards. You're not moving forward. Do it strategically in a way that you can improve your score, but you don't put yourself in a bind and you fall into the trap, because there's a lot of hypocrisy when it comes to having a good credit score. There's a lot of hypocrisy when it comes to having a good FICO score and a good credit report and things like that. There's a lot of things that work in their favor, but not necessarily in yours. So you have to be wise. You have to be very wise. So, example, if you go get a credit card because you want to improve your score, then be very, very wise with a credit card. There's so many people that cannot manage credit cards for whatever reason. And financial institutions have done the science, they have done the psychology behind this to help themselves and not help you. And so they understand that when you swipe that card, that it has a less effect on you mentally than when you're pulling your money out or your cash out of your account and seeing your money leave your hand. So it's two different feelings and emotions and thought processes. It's easier to swipe that card and forget about it than as opposed to pulling that money out directly out of your account and paying for something. So when you go take actions to improve your credit score, when you take actions, like I said, whether you're getting a credit card, be strategic. Understand what is the max limit on that card. What is the utilization rate that you want to stay within when you use that card? And most importantly, don't use the card for something random. You can improve your credit score by using that card for things that you are already going to spend money on anyway. And if you want to be even more strategic, if you're going to improve your score and one of your methods is using a credit card, you might as well pay yourself in the process. What do I mean by that? I'm not saying go get 10 credit cards, 20 credit cards. Uh don't work backwards. By You want to have diversity, but you don't want to have 50 million credit cards, because that's not going to look good either. But if you're going to improve your score using a card, then you might as well get paid in the process. There are some credit card companies, they do have deals. Now, understand every deal can be potentially a trap as well. So be wise in the process. Some credit card companies will pay you to use their card in a number of ways, but I'll start with one. You'll see some credit card companies and they'll say, if you use $1,000 within the first 90 days, we'll give you $250. So the average person has more than $1,000 worth of expenses. The average person can spend $1,000 in Walmart in 1 month. So if they make a deal and say, if you spend $1,000 within the first 90 days, we'll give you $200. The average person is excited. The average person is motivated about this because they know they can get that $200. So that's one way that we're thinking about it, is we're going to get $200. I got to spend this $1,000 anyway, but when I spend this thousand, you're going to give me 200 back. So that means when I get the 200 back, really, I didn't even spend 1,000. I only spent 800. So I put $200 back in my pocket using a card to benefit my credit score and to benefit my cash flow as well. So now when you think about this, the financial institution's mindset is you are not going to pay that card off in full. You're going to swipe, you're going to swipe, you're going to use the card, and there's going to be a balance left over. And when that balance is left over on that charge date, they're going to charge you interest on the balance. So the 200 that they give you, they are confident that they're going to get it back and more. Over a period of time, they will make their money back. But they have to get that plastic into your hand. They have to get that plastic in your hand some kind of way. And the market is saturated. There's so many different companies with different cards. How can I get this card in your hand? I will entice you by saying I'm going to give you money. So what's interesting is a credit card company says we will let you borrow our money to improve your score. to conduct business, to get things done in life, and you will pay us back with interest. Now, of course, the average credit card may be a little bit over 20% interest plus. Some credit cards, when you first get them, they'll start you off at 0%. Once again, if a card starts you off at 0%, that's another way to reel you in. I say the average person probably doesn't need to use credit cards, but there's some people who are disciplined and they can use a card and won't have any problems, and they use it strategically that in a way that benefits them. And I'll dive a little bit deeper into that. There's a way to use credit cards to where it actually will save you money monthly. It'll save you uh, money on not only cash, but whether it's hotel, whether it's flights, but it's if you are using them strategically, because you can get hotel points, you can get mileage, you can get all those things. But if you're constantly paying um, interest, then it's kind of canceling out the free points and the mileage and the money back. So you want to pay that card off before the charge date every month, pay the card off in full. That way you don't get charged any interest, but you enjoy the benefits of the cash back rewards or any hotel points, which I like because I have to travel sometimes, and the mileage. So when it comes to whether they offer you the $200, $250, if you spend $1,000 in the first 90 days, or if that company offers you 0% interest for a year and a half, 2 years, it is to entice you to get the card, not just to improve your score, but that they can put money back in their pockets. So when we talk about does a credit score matter, we understand for some people it does, and for some people it does not, because there is something called business credit. So you can use business credit, or you can pay for everything in cash as well. And from that, then you will have a lower score, but it may result in you having to pay higher for other things, or it may be difficult to maneuver for somebody who wants to get into an apartment. But then at the same time, if a credit score is required for you to get into a certain apartment or apartment complex, there are also landlords, homeowners that you can go stay in one of their properties and they may not check your credit score. So there's always a way around everything. Or you can have someone else apply, or you have a roommate. There's always another way around not having to use your credit score. But when you're using that credit card, like I mentioned, 0% interest, whatever the case may be, utilization rate, try to stay, I would say, below 33% usage rate when you're using that card. I think that's a good safe range when you're talking about usage rate, because you don't want it to get out of hand. You don't want to max out the card. You don't want to be over 50%. It's just going to take a hit on your score. So does a good credit score matter for the average person in America? It does, because it affects potentially what job you may be able to get, your housing, like we mentioned, when it comes to renting a house. And so that's why it's important also to have a good score if you want to leverage certain assets. So the average person who has a credit score, a personal credit score, not business line of credit, if you want to leverage certain assets slash liabilities, your good score will matter. So when I use the example of the property I bought for 30,000, put about 5,000 into it, and now it's worth about a little over 100,000. If I have $65,000 worth of equity, to pull that equity out, I need to, of course, have my credit ran, qualify. And to pull that equity out, I can do a cash out refinance, or I can do a home equity line of credit. So if I wanted to do a home equity line of credit or a cash out refinance, that financial institution is going to want to see my credit score. They're going to want to see my debt to income ratio, potentially my past 2 years of tax returns. Of course, a lot of that plays a role. But if I want to get access to that equity, my credit score is going to matter. So does a credit score matter? To some people, yes. To some people, no. But if I want access to that equity, that way I can leverage the equity in that property, that $65,000, to create more cash flow in another real estate opportunity or another business opportunity. Because when you pull equity out of two things, when you pull equity out of a property, what's interesting, and a part that I think is amazing, is it is not a taxable event when you pull equity out of a property. So if I don't care if you have $50,000 worth of equity, $100,000, whatever it is, when you pull that equity out of that property and put it in your pocket in your bank account, even though you have just received cash, it is not a taxable event, but it is a loan that technically you have to pay back. So with it not being a taxable event, and keep in mind, I am not double check everything that I say. Go do your own research, go verify. That way you make sure you make solid, sound decisions that benefit you. So if you pull that equity out of that property, which keep in mind, that's why real estate is so amazing, because you can make certain financial moves with great tax benefits and tax breaks as well. But if you pull those funds out, it doesn't mean that you have to necessarily go reinvest it into another real estate deal. You may know someone that has a startup business or getting ready to create a business, and you can use those funds in other entrepreneurship avenues to make more money. And so if you do pull money out of a property, then of course you do, and it is wise to use it in another investment instead of just spending and splurging. But if you do have a tenant in that property, then make sure that whatever business move you make by pulling those funds, that equity out of there, uh, that whatever business venture you're getting into next, that it is going to yield enough profit to cover what you pulled out, or the tenant that's in that property, the rent is enough to cover what you pull out as well. Don't just pull funds out of properties without a way to replace them, because you have to pay that loan back. Now, if the tenant that's in there can cover it, worst case scenario, if you put the money in your pocket and go on vacation and have fun, then you're fine. The tenant is paying it back anyway. But don't put yourself in the negative just pulling funds out of a property for no reason. So in that case, having a good credit score matters, because what's interesting is when you are making financial moves in real estate, if it is your own home, your personal home, then you're going to get more favorable interest rates than if you are doing it on an investment property. So keep that in mind as well. Regardless, a good credit score matters, but you're always going to get a better rate if it is your personal home as opposed to one of the investment properties. An investment property, whenever you get ready to make a deal or transaction, you're going to have a higher interest rate on that financing. So keep that in mind. So having a good credit score matters. I'll give another example for someone having a good credit score matters. There was this gentleman, he was into 3D. He had this machine, or he was getting ready to purchase a machine that does 3D housing. He was happy, he had his own business, and he needed to purchase some machine because he had someone who was willing to give him a contract. And with this contract agreement, he was going to build some 3D houses. And the guy had two properties. He had two homes, and one he hadn't rented out in a long time. The other one he lived in, and both homes were worth over about 100,000 a piece. And came to me for some advice because he wanted to get a home equity line of credit and borrow against, pull the funds out of that line of credit to buy the 3D machine so that he could fulfill the contract and make thousands and thousands of dollars. But his credit score was horrible. The pandemic had just hit. He had been out of work and some other things happened. And so he couldn't even qualify for a loan because his credit score was bad and he didn't have a good history the past 2 years of workable of income. So therefore he would get denied if he were to try to qualify for a line of credit. And because of that, his business venture and these contracts that people had waiting for him, he couldn't make a move and couldn't go make the money. And it was funny because he was trying to get me to eventually, once he saw he couldn't qualify, he wanted me to invest $30,000 into him buying these machines, and he was going to pay me back within a certain amount of months. But of course, I didn't dive into the deal. One, because he was a little all over the place and he didn't have his stuff in order, and so I didn't want to risk $30,000 at the time. And all of a sudden, everything falls through the cracks, and I'm out of $30,000. So him not having his score where it needed to be, and him not having the knowledge on how to get business credit, it made him miss out on the opportunity for thousands of dollars in those contracts that he could have made monthly and other opportunities he had. Plus, it looked a little sketchy for me that he had these great deals which worth so much money, but he couldn't find a way to come up with $30,000. So having your things in order, having a good credit score in order, it matters personally, but even when you're trying to do other things, you don't want to miss out on opportunities and deals because you forgot to pay a bill on time when you could just make the minimum payments every month to at least maintain yourself. And I think lastly, one of the last things I'll touch on is I believe that's why it's important that, it's important that we be able to finance our own things that we want to do. I think it's important to find creative ways to put yourself in a position, in a sense, to like be your own bank in a sense. So, in a way that if you wanted to fund something, if you wanted to finance something, you're not limited on what the bureau has to say. You're not limited on what your credit score has to say. And so you can create your own environment of your own community of managing your finances, managing your own economy. And there's a number of ways that we can do that. There's a number of ways that we can become our own bank. We can finance things the way we need to, but we have to lay the foundation. Everyone does it a different way. I'm not an expert on infinite banking concepts through whole life insurance, being able to leverage and borrow against and things like that. I'm not an expert, but it works. I'm not an expert, but wealthy people use that as a method to finance and fund things and become their own bank. So if you don't know about that, read R. Nelson Nash book, Infinite Banking Concepts, Becoming Your Own Bank, and how they do that through whole life insurance policies. That'll be something good for you to be able to research and see the validity on it. Like I said, everything that I mentioned, go look it up, research, see if it's true or not. It may open your eyes to something else. But when you can fund certain deals, opportunities, business deals, and you're managing and financing it yourself, then you take the chains off that these financial institutions may have on you when it comes to those three companies, TransUnion, Equifax, and Experian. When you take those chains off and you can function and move at your own speed and your own pace and finance things, then you'll realize not only can you finance your own things, but then you can start financing things for other people. And guess what? Now they pay you interest. So now you have become the bank in your economy. You have become the bank to fund your personal things and other people's things. So people can come to you. You make the deals. You create the opportunities. And so you can be your own Wells Fargo. You can be your own Chase. You can be your own Bank of America. And so I think that's the place where we need to get to. So does your credit score matter? Yes. For most people, your credit score does matter. But let's get to the place and to the point to where eventually it doesn't matter. And that's where freedom is. That's where a lot of freedom is. Leverage your credit, use your credit score. That way you can leverage it when the time is needed to get to a place to where you don't have to have it if you don't need it in place. And so I like discussing and talking about, as I come to a close, how to be debt free, how to get rid of debt, how to pay things off. And if you do have a mortgage, if you do have a 30-year mortgage, a 15-year mortgage, if you do have a mortgage in place, and let's say you have consumer debt as well, you do have credit cards and different things that you need to get paid off, feel free to reach out to me. I will show you and get you in contact with the right people. They'll give you a free assessment to show you how to pay your mortgage off in potentially 5 to 7 years. And let's say you only have 8 years left on your mortgage. You may be able to pay it off in 3 to 4. You never know. Get that free assessment done. And when you get that free assessment done with Accelerated Banking with the Kwok brothers, we'll be able to guide you through that process from start to finish. I paid my mortgage off. I had a 30-year mortgage in 2020, paid it off completely in 3 years and 7 months. So it's real. I do not advertise or talk about anything that I do not know to be true. And so this is true and real in my own personal life. And so I free myself of the financial institution so that I can move the way I need to. I leverage them when I need to, and then I get them out of the way when I need to. So personally, I want to be able to manage and run things the way I want to. And with Accelerated Banking, with the HELOC strategy, it gives you access to tons of equity later on. That way you can leverage it however you need to as well. But do not pay a 30-year mortgage, especially at these high interest rates. You'll end up paying for that mortgage probably 2 or 3 times, 7, 8%. It's pretty high. And so let us help you out. Feel free to reach out to me. Once I post this in the description, I'll put the link. That way you can schedule a free assessment if you're interested in getting out of debt, especially if you, like I said, if you have a mortgage, you can have a mortgage that's paid off, but you may have $100,000 worth of debt, consumer debt. Still reach out to us. We'll show you how. But if you do have a mortgage and you want to get rid of that debt and you're tired of giving these financial institutions tons of money, reach out to me. We'll guide you through the process. But I appreciate everyone tuning in. It's been another awesome time talking about financial literacy. I look forward to having other people come on here with me to discuss financial literacy. I think it's important that we dive a little bit more into credit scores and whether credit is important or not. So we'll circle back around on this subject again at another time. But everyone for tuning in, thank you very much and have a blessed day. Oh, also feel free to like, subscribe, and comment, especially on YouTube. Feel free to go on YouTube and subscribe. On YouTube, it is Coach Steele Finance Training. And of course, on Facebook, it's just my name, Simon Steele. As of right now, be blessed.